I'm Charlotte McLeod with the Investing News Network, and here today with me is E.B. Tucker, Director at Metallo Royalty and Streaming and author of the book, Why Gold, Why Now? Thanks so much for being here online with me today.
Thanks for having me, Charlotte.
Of course. So usually we have you on to talk about gold, and we will get to that. But today our focus is going to be on a couple of other metals. You're involved in a brand new royalty company called Nova Royalty, and it's focused on copper and nickel. I think most people are quite familiar with your thesis for gold. So today I want to hear your thesis for copper and nickel.
Definitely. So let's explain how all this happened. If you read my book, you know that in the back part of the book, I talk about what I've actually done to profit, position myself to profit for what's happening in gold. It's a very important part of the book because I explain in detail how the royalty business works. And as you know, we've talked about it many, many times. The royalty business is a far superior way to profit from a rising gold price compared to owning gold, even compared to mining companies. There's no better business, in my opinion, than the royalty business. So once you understand how that business works, it's easy to understand why I got involved with Nova Royalty, which starts trading on October 1st on the TSX Venture. It's a direct listing. That means there's no stock sold by the company. We're just listed. Now, Nova Royalty is only copper and nickel. These are the metals that are behind the electric vehicle revolution. Every single Tesla has a huge amount of nickel in the batteries. There's thousands of battery cells in every Tesla. And there's about 100 pounds of copper in most electric cars, all right? So these are huge numbers, and we know that we're transitioning into a world of less fossil fuels. I'm not gonna say zero, because I'm not sure that's realistic, but a lot less and a lot more battery-powered operation, and you cannot make those without nickel, and you can't tie them together without copper. So what we did is we started 2 years ago. We found some copper and nickel royalties over time. We started building a company the same way we did with Metallo. It's totally separate management teams, but some of the backers of Metallo did this. You know, we put this together and structured it. And so people should check out the business and know that this is a similar arrangement to Metallo. The company's in the business of acquiring third-party royalties on copper and nickel mines, very exclusively focused on that. It would be inappropriate to mix that with Metallo, which is a gold, silver. And everyone knows the track record of Metallo. We came public at $1.20 Canadian and traded up as high as $13 in the August rally. And it's been a slow, steady, it's not an overnight sensation. You know, we've gone from 0 to 50 royalties with Metallo. So Nova will come public with 15. And as you can imagine, it's about the same type of approach to the business. And that should kind of let people understand, you know, how did we evolve to now having these two different ways to play two different metals, but with the same royalty business.
Okay, so you see copper and nickel as key metals in the transition from fossil fuels to a more green electricity-based world. But plenty of other metals are used in green energy. And I have to ask, you know, typically we hear a lot about lithium, cobalt, graphite. So why copper and nickel?
Great question. So look, so batteries, okay, you can make batteries out of almost anything. So I talked to a guy who invented the lithium ion battery. This guy was a professor at Texas. And what he told my analyst was that you could make batteries out of sand. You know, there's redox flow batteries, vanadium, all these different things. But the problem is that they've got to hold up in all different circumstances, like crossing a hot desert, you know, in the afternoon in California, and then you're to the mountains and it's cold. Batteries hold charges in different environments. So the batteries are in about the 5th generation of electric car batteries, which just kicked off earlier this year, late last year. And this generation of batteries has a fraction of the cobalt that the previous generation had and double the nickel. Okay, they call it an 811 battery, and the 8 is the nickel component. So nickel is the primary component. In our view, you need lithium. Yes, you know, some of these other metals are involved, but cobalt was extraordinarily difficult to obtain. Okay, everybody knows that half of it came from very controversial parts of the world, and ultimately the economics weren't great, and the battery construction itself wasn't ideal. Okay, so as batteries began to optimize, the role of nickel vastly took over from the other batteries. Now, that's separate from copper. I mean, as you know, copper is the wire that wraps the whole world together. I mean, you can transmit electricity through gold or aluminum, all these different things, but copper is the gold standard, if you will, of how you run electricity through the world. Now, the electric car has a lot more copper than a regular car. The U.S. grid, is desperately in need of some upgrading, and copper discoveries have been very weak over time. And so when we look at how energy is changing, we can see a world in the later part of this decade where a lot of energy is transmitted, to and from batteries, deployed from batteries, all of which has to be connected with copper. And so that's how we got into this. And that's why we didn't like the economics of some of the other metals. I mean, nickel is very, very unique. It's less than $7 a pound right now. And I hope you're not too shocked by this, but we think it eventually goes over $25 a pound. I mean, there's just, the supply of nickel is not great. And that's why you've seen Elon Musk, multiple news stories this year that he's willing to set up a long-term lucrative contract with someone to supply him with nickel. Think about that. I mean, that's twice this summer he said that. He just did a lithium deal, in the desert. That was easier. But the nickel side of it, you got a huge component coming from Russia, huge component coming from Indonesia, some from South Africa, and then you start getting down to it, and there's some Canadian supplies and North American, let's just say, supplies, and some Australian supplies, and the market is very, very tight. And so when that changes, there's not a lot of royalties to go around. It's not like gold. There's a lot of gold royalties, like many, many, many. So you have to pick through them wisely, of course, which is the key to building a great royalty company. But with these other metals, they have unique economics.
Well, and these metals, like we're talking about how they're going to be used in batteries, green energy, they still have all of their traditional uses that are continuing to apply. So how do you see those dynamics working together?
Yeah. Well, it's accurate question, because what happens is people look at stainless steel consumption and they see that it's about flat, and how much silverware is being, stainless steel silverware is being produced in refrigerators. And I mean, all that is about, that's not that exciting. I mean, the huge driver of demand growth is electric vehicles. You saw this week, California says, no more carbon-based vehicles, but they set a deadline as well. I mean, you see many countries in Europe leading this charge. I mean, the Chinese are trying to make a car that's even cheaper than Tesla's lowest model price. I mean, the writing's on the wall. I mean, there's going to be gas-powered vehicles for a long time. There's just going to be less and less of them. It's not that they're going away. It's just the number of them is in decline. The number of electric vehicles is rising. So I mean, that's the driver of demand, and everybody knows this, but they don't know what to do about it. They're like, well, I can't buy Tesla stock. It's too expensive. Okay, yeah, but you don't want to buy the automaker. You want to buy the energy component for the automaker. I mean, think about it. If you bought General Motors or if you bought Exxon, 50 years ago, which one performed better? I mean, it's an obvious answer. So I mean, Nova Royalty will trade on the 1st of October, NOVR ticker symbol, and people can see the investor presentation and see that the people behind Metalla is the same group, and the reputation of those people, should be pretty abundantly clear by looking at Metalla. I mean, we're building another royalty company focused on these metals, which we think are in high demand and will continue to see stronger demand over the next few years.
Okay, great. I wanted to ask, do you have a geographic focus for the portfolio of royalties that you're gathering? We've been talking about Elon Musk and Tesla, and North America has been in focus because of the recent lithium deal they did, and I know they want to do more sourcing from North America. So what's your take there?
So that's important to discuss, because with Metalla, we had to do the same thing. And what we decided to do was we decided to look at the world kind of on a map, and we say, you look at different regions: North America, South America, Africa. You can segregate, because some regions are there's a lot of varying mining kind of attitudes towards mining, right, from different leaders. It's not fair to say Africa's just one. But then you look at Asia, Australia. You kind of put everything on a map, and what happens is that you see that the North American royalties carry the strongest premium, generally speaking. Not always, but generally speaking. Australia carries a strong premium. South America does pretty well. Okay, then you start moving to the east, and things aren't as good on a valuation basis. Okay, so when we look at building the company, we say, well, okay, our primary target is in regions that carry a strong valuation, because when you get the mining license, when you own the royalty, you can defend it in court. You can have a reasonable corporate structure. You're not necessarily worried about showing up and you can't get in the mine. Okay. So as you progress to the east, the valuation, tends to change. And so building a royalty company, if we don't want to look at royalties all the same. If we go to a controversial region of the world, we might pay a much lower valuation multiple than, say, 6 miles off the main highway in Ontario, which is you can stay in a nice hotel at night, and visit the mine. So it's not so bad. So that's the way the world works in the royalty business. And you've got to be aware that as you put things together, with Nova, we've cobbled together some British Columbia, so eastern side of Canada. We've done some, you can see all this in the presentation, but you'll see us do more and more in the Americas, Australia. Like, this will be our focus. And then we will pick up other things. We're just not very, very enthusiastic about going to places that are controversial. Because look, Elon Musk is saying, look, they can't go over to a war zone and have a 20-year agreement to buy nickel. It's impossible. You can't do it. It's too controversial. You have shareholder revolt. You can't do it. And so that's why the royalty is also valued lower.
Okay, so investors hear quite a bit about precious metals royalty companies, and you already mentioned that there is a reason that you had to keep Metalla and Nova separate.
Yeah.
So why is it that royalty companies focused on other metals are less common? Why do you need to keep them separate in that way?
So there's first of all, there's not very many nickel royalties. There's not a lot to choose from. There's a decent number of copper royalties, but there's also not that many. And copper and nickel mines, base metal mines, they go for years. Sometimes these mines will go for 40 years. If you're landing at Salt Lake City Airport in the US, you can see out the left side of the plane as you're landing, one of the largest copper mines in the world. You can see it from space. The thing is giant. You've never seen anything. 100 years they've been digging around on this thing and messing with it. So these things go on and on and on and on and on. And so these metals have different economics than a gold mine. The price of these metals also doesn't tend to run in the same type of pattern that gold does. And so when you consider all these factors, what happens is that the market puts a different trading multiple on base metals. So just to make up numbers for you, in the book I explained, you got to value royalty companies on price divided by net asset value. I know that's a bit complicated just to mention, but I explain it in simple, easy to understand terms in my book. So let's say royalty companies trade at 2 times, 2.5 times net asset value, and base metal company might trade at 1 to 1.5 times net asset value. It's not a hard and fast rule, but the trading multiple is different. If you mix them together, then you would just get an average of the two, which would pull down the precious value and pull up the base value. So it's not appropriate. You got to have 2 separate management teams, 2 separate companies, because you got 2 separate metals.
Okay, and the process for acquiring non-precious metals royalties, are there different metrics that you look at? What do you do? How do you approach that differently?
It's the same fundamentally. We're buying royalties from third-party owners. That means, company A has a royalty on company B. We come in and we buy it from company A. We're not initiating a deal. We can, but it's not usually the case that we're initiating a deal with the company. So that part of the process is the same. Where it's different is forecasting the mine life. Some of these things have got 40-year mine life, 50-year mine life. That's crazy. A gold mine typically will have a shorter proven period of mine life. They'll expand it as it goes along. So you kind of know they'll do that. But we've got a royalty on Dumont, for example. You look at the plan for Dumont, and it's a 3-kilometer wide hole in the ground that's going to produce ore for half a century. What? Think about that. This is amazing. So it's the size of a city, So anyway, so when you look at that perspective, you've got a Microsoft Excel sheet modeling this, and it's a lot longer, So anyway, so that's a bit of the difference between the two.
Okay, so Nova Royalty, not trading yet, but very soon. What else should we know about it?
October 1st. Yeah, October 1st, NOVR, Nova Royalty. People should visit the website, see the presentation, see the people that are involved. You're going to see it's a lot like Metallo. Now, Charlotte, I got to tell you something, and I tell the story in the book. I came on all these shows, and when we started Metallo, it was $1.20 Canadian, and I said, here's what we're going to do, and nobody listened. And now I can see behind me it's 1080. Okay, it's been as high as 13. We paid a dividend. We've done all these different things that we said we would do. We've done it. And people say, man, I really should have bought some of it back in the day. I mean, the time to look at a company is in the early days. And when you look at the Nova presentation, you don't have to just believe what we're saying. You just look at what we've done with Metallo. It's the same backers. It's the same business strategy. I mean, this is not some lifestyle company where we're renting nice offices and buying nice rugs and pictures and stuff. This is a scenario where we do something well. We know how to build royalty companies, and we're wide open about telling people how we do it. There's no secret sauce. It's just hard work and focus. I mean, a lot of people struggle because they can't focus. So we do that very well. We've done it with Metallo. We'll do it with Nova. It's day in, day out, building a business with a really strong trajectory, and that's what we'll do. So October 1st, it'll trade. TSXV, it won't be available in the US for a little while longer, but that'll come too. But people should at least have a look at the presentation, see the people behind it, see if they can see a quote of NOVR, and keep an eye on what we're doing.
Okay, well, perfect. We will look forward to that. And before we let you go, I mentioned at the start of this interview, usually we talk to you about gold. I don't think we can let you escape without a few quick questions on gold. We're in a little bit of a pullback right now, but it's been a good performance from gold this year. Where do you see the price by the end of 2020?
So I'm looking here. We're 1895. We're pushing 1900 again, which was the old high. So remember, all we've done is break through the old high, come and stabilize. I know this might be shocking, but 2,500 by the end of the year and $40 silver. People have a hard time with that. It sounds like a big number, but we see all the evidence. The U.S. election, if it's Trump, if it's Biden, it's really good for gold. There's different reasons why, okay? But it's a supremely bullish time for gold. It's not that exciting of a time for stocks. You certainly can't put your money in bonds. You can't have your money in cash because the Fed's telling you they're going to inflate at 2% and you're getting zero money on your cash. You're losing money. All signs point to gold. But Charlotte, let me just tell you, all the gold in human history ever mined is worth $12 trillion at this price. And the U.S. is trying to do almost half that in stimulus and deficit stimulus this year. I mean, think about it. They're fighting in Congress at 2.2 trillion and another 3 trillion. Well, I mean, these guys have finally figured out that it doesn't matter how much money they print. I mean, I say it in the book. I explain this. I mean, when you finance the money at nothing, you can just print as much of it as you want. And once they get into that, they'll never stop. So $2,500 gold by the end of the year. I don't know if it'll stay above that, but we think it'll at least touch that, and then we'll see from there. And I'd love for you to have me on and hold me accountable, because obviously, we've done that in the past and we've been pretty right on, and we think that's the way to do it. And how do you play it? I mean, if you buy gold, it's okay, but I mean, the royalty company is the way to play it. Metallo, MTA in the US and MTA in Canada. It's been a great performer because you capture 50 royalties and all that goes along with that. And as the value of gold climbs, you get great exposure to that owning royalties. So I tell people in the book, I play it through the royalty business. Physical gold is great, but the royalty business is the best way to invest. Your gold is an asset, not an investment. It's an asset. So you need an investment component if you believe the prices are going higher. Metallo is what that is for me.
We do hear that royalty companies tend to move first when the price is moving. So I have to ask, I think I know your answer. Is there still time to get into companies like that right now, even with gold at its current level?
I'm worried I don't have enough. I mean, you're asking the wrong guy. I mean, I bought stock this week. I mean, I'm very proud of what we've done. I mean, the company, I've been on the board since, early 2017, which was, company was maybe 60 days old or something, less than 90 days old. I just am very excited that we created a structure that allowed Brett Heath and his team to build. And you look at the chart in the presentation, and we have a little mark for each thing that happened. Each deal that we had brought in new partners and new royalties, and that to build a house, you have to have a foundation, and then each floor has to go on one at a time. You don't just go to the top, the spinning restaurant on the top. It's not the first thing you build. You have to build it one layer at a time, and that's how we built the company. So obviously I don't know what's going to happen, but I mean, I'm really happy. I mean, I'm very proud of our guys, the assets we've acquired. Their assets on Agnico Eagle, Pan American Silver, Goldcorp Newmont, Barrick Gold. I mean, this is not little tiny, junior companies. I mean, this is the world's leading mining companies. And we got these assets. I tell you in the book how we did it. We didn't go to Goldcorp and say, can we loan you some money for a royalty? It wasn't like that. We bought these from third-party owners. And it's really important to understand that, because we're not in the business of financing mine development. We're trying to buy development stage royalties primarily. And as the gold price moves and you get into a mining cycle, those royalties have tremendous growth potential, because Agnico and Pan American, all these guys, just when they push on something, they go hard, and these become serious productive mines, and the cash flow goes on for years. And Metalla has tried to position itself to benefit from that. So is it too late? Doesn't look that way to me. But we'll see over time. In the book, I talk about this like innings. I mean, innings of a game. I mean, you're in the early innings. This is the early innings. I mean, touching the old high on gold is nothing. I mean, compare what we're feeling now in the economy to 2011. Think about that. I mean, that 2011 gold hits 1900, then falls for 5 years. I mean, and then has a slow rebound. I mean, think about it. It's like what happened in the world from 2011 till today. A lot. That's a lot happens. I mean, gold's got to price all that in and find its own legs before it starts climbing. And that climbing has just started. I mean, this is only a pause at the old high. So 2,500 will wake people up, and that's what we think needs to happen before mainstream investors will get involved. And that's ahead of us now.
Okay, well, thank you so much. That sounds like a nice place to leave it at. And certainly we will call you back if and when we see that $2,500 gold and $40 silver. Thanks so much for being here today, EB.
Thank you, Charlotte.
Thanks. And once again, I'm Charlotte McLeod with the Investing News Network, and this is EB Tucker.